Good morning, everybody. Welcome to our live stream for Rebel Income. I apologize for starting a couple of minutes late. I had a couple of technical difficulties. Wanted to make sure that my audio was working correctly, and but I appreciate those of you that are here, and I'm looking forward, as always, to our discussion and the things we have to talk about today. Really quickly, just take 1 minute. Just want to talk for a minute about how to interact with the community as well as with me. If you're on Discord, one of the things that you can do is one of the things I'm giving you access to is the open discussion forum. This is an area where you can post messages to each other as well as to me. You can also message me directly in Discord if you want, just by going up here to direct messages and then selecting Rebel Income from the menu that you'll see over here on the left. I pay attention to the open discussion thread as well as these direct messages throughout the course of the day, and I'll do my best to respond to them just as soon as I can. You can also email me directly if you wish during the week at rebelincomesystem@gmail.com, and I'm putting that email address in the chat thread right now. If you haven't made a note of that previously, please do. Okay. With that said, it is Friday. We're looking at the first Friday of the month of March, and that means that we have some weekly options to pay attention to. Obviously, a lot of activity that's been going on in the last week. So let's go ahead and get things started for just a second by pulling the curtain back on the broad market. Let's talk a little bit about what we've seen in the last couple of weeks. Saw the market find its latest high a couple of weeks ago, a little bit above 6,100, about 6,200, and since then we've seen some pretty clear bearish momentum. What do you think? Is this we even have it right now? This is the S&P 500 is crossing down below the 200-day moving average, which I like to use as an indication of the long-term trend of a stock, or in this case, the index. What do you think that means? Let's throw this out a little bit. Is this a sign that we're going to be looking at a new market reversal? What are your thoughts? You can go ahead and put those in the chat, and let's try to open up the discussion a little bit. Barry, it's probably too soon to tell the long term, as it could just be reactions to tariffs and such. And that has been kind of the theme for the week. Thank you, Barry. I do agree with a lot of what you're saying there. We are seeing a lot of reaction to news about tariffs, and the market obviously not liking that right now, and that is giving the market a reason to sell off a little bit. The interesting thing and the critical thing is, a lot of people, I've seen a lot of analysts start talking about corrections. And so I want to take just a minute, and I want to talk about the difference between some of the different moves against a trend that happen, and how we want to be careful about how we categorize them. It's easy to get caught up in this kind of movement. Let me zoom in again a little bit here. It's real easy to see this and get caught up in it and say, wow, that looks really bad. And almost 2 weeks of steady bearish pressure is not to be minimized necessarily, because there's been a lot more selling activity and pressure than there is buying enthusiasm. I think that much is clear. At the same time, the levels of these moves against a longer term trend really need to be put in an overall broader context. So really quickly, let's do some math. I'm going to draw a line from this top of the market, which is about 61.45, down to the low of the market so far today, which is about 56.66. All right. So that gives us our range. We can see there's been a move of about a little over 500 points in the index from the top to the latest bottom. So let's try to put that in context. Let's go 60, and I'm going to round up a little bit here for simplicity's sake. But 61.45, the low 56.66. 479 points total, so not quite 500. Now, when we divide that against the 61.45 high, we get a total move here of 7.8% roughly. So that's how far the S&P 500 has corrected, for lack of a better word, against the overall longer term trend of the market. So where does that fit in terms of correction, bear market, etc.? Do we need to really be thinking in these kinds of really critical terms right now? So again, if you've read different texts about trends and retracements and moves against a trend, you'll see that there's different terms that are applied to different levels of a move against a trend. Let me get my typing tool here. And so I'm going to go a couple of different colors here. All right. So the first term we want to think about is what a lot of people will call a pullback, a drawdown, or a retracement. And this can typically be anywhere from 5 to 10%. And that's just kind of normal. Barry, now would have been probably a good time to load up on buying puts for those who focus on that style of trading. Well, a week ago would have been better, right? Ideally. We'll get to another element of what you're talking about that means that I'm not entirely sure that you're wrong, but hold on to that thought for a moment, Barry. Thank you. What this means right now is that no matter what you might hear from other analysts, from other so-called experts, other people who are kind of ringing the alarm bell, is that even with as severe as what we've seen in the last 2 weeks looks, we're still really only in pullback, drawdown, retracement territory. Retracements and pullbacks, all of these are synonymous with each other. All of these are really, really typical within broader trends. They're normal. They happen because inevitably, no matter how strong a stock or a market may be, people are going to start taking profits at some point. Those who got in at an earlier stage are going to reach a point where they're comfortable with the profits they've made, and they're going to decide to start taking them. And when that happens on a larger scale, then you start to see these retracements, these drawdowns, these pullbacks. So these are something that are not necessarily unusual or something to be extremely concerned about. Okay, next we have corrections. Now, the term correction is considered to be more serious, more severe than what a pullback or a drawdown or a retracement would be. But a correction really doesn't start until the market or stock that you're looking at has dropped by at least 10%, and it could extend all the way to, excuse me, to minus 20%. I've seen some analysts already throwing out correction talk out there. Truth is, we're not there yet. We could be. We could start to get there. I'm not going to dismiss that possibility. But corrections, while they are more severe than a pullback or retracement, are also fairly typical within the scope of broader overall trends. Let's go back to here. I want to zoom out here for a moment, and I want to consider what the difference between something like a retracement versus a correction. All right, so this is going all the way back to 2023, where the first part of that year, where really the downward trend from 2022 stopped. And excuse me. I'm going to highlight here a couple of different areas. Here's a correction. Correction with a C. Here, this was nothing more than a retracement, R. Here is a little bit closer to a correction. Retracement. 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 And I'm going to put a question mark here because this drop below the 200-day moving average does raise the question of whether or not this move is going to be a little bit more severe, whether we're going to see this drop into clear and legitimate correction territory, and that's totally fair. Okay. The final question is then, where does a bear market start? If a pullback is normal, if a correction is less frequent, but still not abnormal within the context of a longer upward trend, where does an actual bear market come into play? So we see the ranges for each one of these. So what I'm about to put here shouldn't be too much of a surprise. A bear market starts at 20%, and it goes from there. And exactly how steep that will go, nobody really knows. A long-term bear market can go as much as 50% or more against where the market had previously topped out. Think about the think about the bear market that started in 2001. Think about 2008 as well. Those were bear markets that retraced more than 50% of their previous highs. Sorry, I kind of drew a blank on what kind of terms I wanted to use. So we're still a little bit we're still a ways away from these levels that I would call where I would say, okay, we're actually looking at a legitimate new reversal down to a downward trend. Corrections and retracements are all things that happen within the scope of longer upward trends and that ultimately allow a long-term trend to extend itself further. So go back to blue here. Here's a correction. and then we saw the upward trend extend itself, accelerate. Here's a little bit of a correction. Again, extend itself, etc. So what does that mean for what we're seeing right now? Again, the jury's still kind of out here. We don't know exactly what if this is going to become more severe, but these levels, this next one should be 10 to 20%. These levels are things that bear watching. We want to pay attention to these and be aware of them because they can mark signal points where some of the adjustments that you may decide to make to your investing system may become a little bit more prudent. Barry talked about if you want to buy puts, maybe the time to do that is now. And I think that what you're talking about, Barry, and to kind of lend some credibility to what you're saying is this break below the 20-day moving average. For a lot of technical traders, this is a signal level. And this isn't a recommendation one way or another here, obviously. But there are a lot of technicians who may take that as a signal. And if they do, then there's probably a little bit more downside to be had. We'll see where this ultimately settles. Give excellent question. I love this. He says, where is the 10 to 20% start point? So let's take that high, 61.45. We're going to multiply that by 0.9. So this gives us our 10% level, right? 5530.5. That means go back to my drawing tool. 10% level, I'm going to use a purple line here. There we go. Is right around here. This is 10%. Thank you, Gib. I appreciate this question. There's 10%. And then 61.45 times 0.8 is 49.16. This gives us our 20% level. I'll switch this to red, 49.16, all the way down here. So we can see there's actually quite a bit of distance to go before we hit bear market levels and, a really pretty wide range between 10 and 20% before it's really going to be time to say, okay, this is actually reversing. This doesn't, again, I'm not presenting this as a way to say, oh, the market is okay, don't worry about it, we're going to reverse and go back up. I don't know that that's the case. Right now, the market is clearly nervous, and we're seeing a lot of uncertainty, especially as trade question becomes more prevalent. The U.S. is imposing tariffs, and the countries that are having those tariffs imposed are imposing tariffs on their own back on the U.S. And we'll see where that goes. If you paid attention to the State of the Union address this week, no matter what your political side of the political fence you're on, it was interesting to hear the president acknowledge that those tariffs are probably going to cause some pain, and then he said that was okay. That implies that the administration in the U.S. is willing to ride through that a little bit. They believe that strongly in what they're doing. I'm not going to argue whether or not that's correct or incorrect, just saying this is the environment that we have to work with. As put sellers, as value seekers, that does a couple of different things. Number one, it makes the search for value a lot more interesting because a lot of stocks are under a lot of pressure right now. Some of them for good reasons, because the effect of inflation and rising costs has caused a material impact on some of their bottom line results. And some of the companies that I've been paying a lot of attention to in the past are stocks that right now do not fit my criteria for a good trade. A really good example is the stock that I published my report on this morning, uh, which was Dino. Um, this is this is an energy company, has an amazing value proposition, but there are some holes in its fundamental profile that are severe enough to say, well, let's hold on, and maybe we need to see some things reverse. And so, Dow is another one. Here's a bellwether company that I've followed for a long time. I really like, um, but they've seen enough deterioration in some of their fundamental metrics that right now they just don't represent a good value. So there are stocks that are going to offer some interesting value propositions. What I'm saying is that we have to be really, really careful to make sure that the trades that we do decide to take under current market conditions really are very, very clear opportunities. Means that it's a good time to become more selective than less. You may see me in the weeks ahead decide to pass on a trade on a Tuesday trading alert, just because maybe there isn't anything right now that looks the way that I want it to look under current market conditions. Um, that's okay. This idea of not having to place a trade every week, even though that's kind of the way that we've set this up, is part of the discipline of good trading. And I hope that even when you see the alerts that I'm sending out, that you're not just taking them at face value, that you're running through some of your own analysis and deciding on your own if that's one that you would be comfortable taking. Barry, I know you've shared some comments in some of our recent webinars where you decided for different reasons not to take some of the trades that I've posted myself and that I've placed from week to week, and that's a good thing. Right now, being more selective is going to be wiser. And as always, let me go ahead and bang my position sizing drum again here. The emphasis, the other thing that we should really be focusing right now on is when you do take a position that you think is a good opportunity, make sure that your position size is really conservative. I'm trying to limit my position sizes to no more than 1 to 2% of my overall account size right now. And if you can tailor your trades to be in kind of that same range, I think that you're going to be in a better position in the long run. You'll still have some stocks that you're working with that may offer some good opportunities. But even if those drop into more severe downward trends, like we've seen a lot of these companies doing right now, uh, the impact on your overall account will be a little bit more muted, and it'll be a little bit easier to manage those positions on an individualized basis. Okay, I've talked a lot. This is a lot of me getting on my soapbox, I guess. Excuse me. Let's go ahead and talk about some of the positions that we've been focusing on and that are coming up here. Excuse me. It is the first week of March, and I really only have one position that is set for expiry today, and that is the put sale on Halliburton that I placed the last week of February. So this was a nice 9-day trade. Brought in about a little over 2% in premium on this one, selling the $26 strike price. And guys, if you have better numbers than I do, I would love to see them, and I'd love to pass around some tally marks, rally points, whatever we want to call them, I guess. But here's what I'm set up for: $26 strike, 56 cents is what I brought in on the premium for my 2.15%. So let's go ahead and take a look at Halliburton and see where we stand right now. Okay. As always, I've got to pick the right company. Sorry about that. Here we go. Okay. So the stock has been dropping quite a bit. Here's the level it was at when I placed the trade, and we saw it drop pretty sharply back. Last 3 days, it started to pick up some momentum here. So we're at 25 now, and I sold the $26 strike. So that means unless we see another rally of about $1 in the next couple of hours, that I'm going to take a new assignment. That's okay. This is a conservative position. I sold 2 contracts at 26, which means that the total amount I have on reserve in this is total amount I have in reserve is about $5,200. So this is a good conservative position size. Just to kind of do the math here and show you what I mean. 294. So it's a little under 2%. So I'm within the 1 to 2% threshold that I'm trying to emphasize and make sure that I'm focusing on. So that one's okay, and I don't mind taking that assignment. Barry says that he brought in about 1.8%. So I guess, does that mean, here we go. I gotta get a rally point. Hi, Jay. Don't worry about being late. I'm just glad you're here. Welcome. So I gave myself a rally point. Sorry, Barry. So I did a little bit better, but still 1.8%. Remember, we're talking about a 9-day trade. That's a still pretty nice result too, as well, right? If you can repeat that process, just think about this on an annualized basis. 365. Let's divide that by 9 days. Means you're possibly placing up to 40 trades per year with the same capital, and that would mean 1.8 times 40. If anybody has a problem with this number on an annualized basis, then this may not be the system for you. But this is the kind of thing that is possible. Again, it's very simplified. These are very simplified numbers, but this is the kind of thing that is possible with a good income generation system. So, thank you, Barry. All right. So this is Halliburton. I'm not afraid of taking this assignment. Again, the market is becoming a little bit more uncertain, a little bit more volatile, but it is interesting that in the last 3 days, even as some of the speculation has been increasing on the bearish side, Halliburton has seen a little bit of a rally. It's kind of diverged from the market right now. And I think the part of that is a reflection of the company's overall fundamentals, some of the things that they have going on in play, and the fact that this is a stock that is deeply, deeply discounted at this current price right now. Now, it's probably worth pointing out, even if I do take an assignment here, I missed out on this dividend. This was the ex-dividend date on this one was 2 days ago. So I'm taking assignment 2 days after the ex-dividend date. I was not a shareholder of record on that date. I will not get that dividend. Whether or not I hold it long enough to qualify for another dividend, we don't know. But if it does continue to follow this momentum up next week, not a given, just saying based on the way that it has been moving the last 3 days, then it could be up near 26 by Monday or Tuesday. And that may offer a nice opportunity to start working with covered calls. What if you're in a position right now, like me, where you're looking at an assignment on Halliburton, but you don't want to take it? There are still a couple of hours before the market closes today, and that does mean that if you need to, you can close out the trade by buying the option back. Now, I sold the $26 strike price. and that is this one right here. And that's a little bit of an outsized spread between the bid and the ask price. So let's pull up the details here. Interesting. There's a good amount of open interest and a fair amount of volume. I would normally expect this distance to be a little bit narrower, but even with that in mind, if you were of a mind where you did not want to take this assignment, buying the option back, going ahead and paying that $1.06, for example, you'd have to count that against the 56 cents that I brought in when I sold the put option, but that would eliminate the obligation immediately. I would have to eat a 50 cent loss on that. So $50 times 2 contracts times 100 shares means I'd be taking a total loss of $100 on my account. So let's throw this out to the group a little bit. Maybe there's some of you that think that maybe that's the right move to make. Why do you think it might be? I think there's some interesting considerations and questions to answer about this. And this is going to vary depending on the individual and what your preference is. So I'm really interested. Gibb says roll it. Okay. So you're talking about buying it back so that you can roll out to another week and keep generating income. Remember, in reality, if you were going to roll this, it might have made a little bit more sense to do this a couple of days earlier. You would have had to do it at a lower strike price. To do it the day of doesn't give you as much flexibility, especially when it comes to trying to manage the spread between the bid and ask prices. It does eliminate the obligation, so you don't have to buy the stock at 26. And if your concern is that there's a lot more downside in the stock beyond wherever this is what, about 24.50. If you see a lot more downside below that, then maybe that makes a little bit more sense. Halliburton is in the midst of a legitimate extended downward trend. This is a stock that is already in its own bear market, and we can trace this all the way back here. We see this long downward trend that my line is roughly parallel with the 200-day moving average. There's just no other way to describe this except what it is. From about $44 all the way down to 25. We're looking at a stock that is down not quite 50% over that time period. So this is in its own very own legitimate bear market. That doesn't mean that it's done, even though it's already in an extended bear market. We can see here going back all the way to 2020, stock has been below $10. So it's not unreasonable to say that there could be more downside. It is certainly not a given that the last 3 days of bullish momentum are going to be enough to reverse the stock's bearish momentum or trend. We've seen a few different retracements and corrections of the bearish trend, right? Here's a retracement. This looks like a correction. Here's a retracement. This looks like a correction. Maybe a correction. Here's a retracement. Had a lot of those happen over the course of the last year and a half, and all of them have led to a continuation and extension of the longer term downward trend. So this could still last a little while. So if that is something that is of concern to you, then maybe it does make a little bit more sense to be conservative, to buy the option back, eliminate the obligation, and move on. if you're like what Gib is saying, and you want to just you still like Halliburton, but maybe it makes a little bit more sense to try to work with it at a lower price. Let's say that you buy the $26 back at the current asking price, $1.02 now, and then you roll it forward. Here's 25, which the stock is almost on top of right now, 31 cents. Look at that. Look at that spread. That's interesting. Here's 2 weeks going out to 25 again, going down to the 25, getting a little over 2%. 3 weeks, 70. Go out a month, you can go all the way down to 24 and get about 41 cents. That doesn't offset the 50-cent loss in my case that I would have to take. So I'm not sure I personally would love the idea of rolling any of these, but some of these may not be terrible choices. Boy, we're seeing some pretty severe shifts against these in the bid price against the spread between the bid and the ask. That's interesting. That could be working a little bit right now against sellers. So to me, this might be the kind of thing where it might be better just to buy it back. If you're afraid of that downward trend, buy it back and sit and give it a couple of days, wait and see what else happens. Possibly go and look for a different stock, look for greener pastures elsewhere. Again, I'm not making a recommendation here. I'm okay with being assigned at $26 with the stock right around 25, even with everything that I've said about the fact that I think that this bearish momentum may not be done. A week ago, I thought that maybe we were starting to see some consolidation between 25 and 27. We broke below that level now. And now we may be wondering if there's going to be consolidation between maybe 25.50 and 24.50. Hard to say for sure. But bearish momentum on this is clearly down, even with the last 3 days. 20-day moving average clearly pressing down. 200-day moving average clearly pressing down. So this is one of the things you have to be willing to acknowledge and think about and take into consideration when you're selling put options on deeply discounted stocks, trading at these historical lows. You know, how are you going to manage these trades when they move against you? If you're going to take an assignment, if you're worried that maybe the trend could accelerate and extend even further to the downside. I like Halliburton. I like them a lot, in fact. Of companies with exposure in the energy sector, crude oil specifically, I think that they are better positioned than a lot of other companies right now. And even as I think the price could still continue to be a little bit volatile, I think that there's a lot more opportunity to be had in the long term than overall risk. So my normal method holds here. I'm going to go ahead and take the assignment, assuming that it closes below 26 today, and look for what happens, what might happen next week. If what Barry said earlier, that says it's probably too soon to tell the long term, as it could just be reactions to tariffs and such. You know, market is an emotional animal. Let's remember this, and that means that a lot of times what we see are immediate reactions to what the market may perceive as bad news or what we may perceive as not great news. We'll see emotional reactions to those in the short term. In the medium to longer term, the market tends to kind of not necessarily revert to mean or median, but it tends to moderate itself a little bit based on deeper, more critical information. And for an individual stock, that means fundamentals. For the broader economy, that means economic data and some of the things that drive decisions by the Fed around interest rates. So, all right. So we'll see what happens. Barry, this week I jumped back into. Gib, I will get to your comment because that one's interesting. But Barry, this week I jumped back into NVDL, $38 put that expires today with $0. So NVDL, thank you, Gib, or Barry, sorry. This is a this is an ETF that is tied to NVIDIA in a kind of a reverse fashion. And so, or excuse me, not in reverse fashion, just offers the opportunity to work with the same kind of movements you're going to get in NVIDIA at a lower price. And so, Barry brought an 80-cent premium for a 4-day trade. Okay, awesome, Barry. You get a rally point. So that's pretty great. Gib, we don't talk about it much, but I would look at a short call strangle. That's interesting. So what you're talking about is, good heavens. What you're talking about is selling a call and buying a call where the emphasis is on the short side. It specifically that will usually mean right. That will usually mean selling a call maybe close to in the money or at the money, and then buying one at a little bit lower price. The idea being that maybe you'll bring in a positive overall credit, and if the stock continues to drop, you'll have an opportunity to buy it without necessarily having downside all the way to the bottom. I'll be honest, I don't love short calls, whether they're by themselves or if you're putting them into kind of a strangle. I would rather in that case if I'm going to sell calls, I'd prefer just to own the stock outright. To be completely honest, and that's just because, especially since I focus on dividend-paying stocks, what you're talking about is kind of a variation on a covered call, but you're not getting the advantage of any kind of dividends by working just with the options. And I'm not sure that you increase your probabilities any more than what you would have if you were just doing covered calls. A lot of people in our group have taken assignments on stocks, and then as a downward trend extends itself, they will sell covered calls at those lower prices to keep the income generation going. And the caveat to that, I kind of like that approach. The caveat is that you have to be willing to be nimble. If the stock rallies back strongly against that covered call, or in your case, against a short call position, you have to be ready to move quickly in order to limit the total exposure that you have. If I've sold a call, let's just say that I took an assignment at 26 on Halliburton, the stock drops down to 23. If I sell a call at 24 and suddenly the stock is at 25, 25.50, 26, now there's a risk that I'm going to get called out at a price that's lower than the price I bought the stock at. So you have to be plan and be ready to be nimble when those moves against the overall position happens. So speaking for myself, I don't love the idea of anything related to selling calls except covered calls. Yep, that is just my preference. And if you have found use in placing doing a short call strangle, then that's fine. There are ways to do it successfully, and it is something that I have seen a number of people that I've worked with use to fairly good effect. Hold on a moment. Okay. Apologize. All right, let's go ahead and move on, and let's talk about some of the other things we have coming up. Next week, there's the only stock that I have that has a trade that set for expiry next week is a covered call on CVS. This is a stock that I was assigned in the final quarter of 2024 at 64, and I had an opportunity the end of February to sell a covered call at 65. So let's check in on that one, see where that stands. Here's CVS showing some really nice momentum. Seeing a nice upward trend that's a little bit different than what we're seeing from the market right now. And as of right now, it's nearing $67. So all things being equal, it looks like this is in a good position for me to be called out at 65. This does mean I'm giving up $2 of capital gain, right? Here is roughly where the strike price that I sold for my covered call is located. So I'm giving up everything above this point. I'm not going to get any of it. I'm okay with that. This is a trade that gave me, a pretty nice premium on it. Brought in $1.18 on this one, and a little under 2% for 2 weeks. That's a nice result. I like that, and so I'm very comfortable being called out at 65 and getting the capital that I reserved in that position, which was $6,400 for my 100 shares. Getting that back and being able to redeploy it, assuming that momentum continues. We do see the stock should have some pretty solid support from a technical standpoint around 62, possibly 64. It looks like it may be moving that up again. The 20-day moving average is a little bit below 64 right now, so we have possibly support within an overall trend, possibly increasing as well. And sorry, I used possibly a lot in that sentence. So this so far is looking like a pretty good position. We'll see how that filters out and settles itself next week. Barry, it would probably cost you more to buy it back than the difference in call out price versus actual price, holding all things equal. And I believe that is true. And that's the other reason why I'm actually very content to let this call me out, assuming that happens in 2 weeks. And what you're saying is a really good consideration and question to answer. There is still a week to expiration on this contract, and so if there is a lot more upside to be had, if you're looking at this and you're saying, "Wow, look at this! Here is this resistance at 68. If it breaks that, boy, We might be able to get all the way up here to somewhere between 72 and 74. Wow. This looks pretty awesome, right? Woo! Maybe I want to try to ride that. And so if that's the case, then thinking about what it would take to possibly buy the call option back may be worthwhile. Remember, I sold the $65 call. I brought in $1.18, and basically I would have to pay the difference between the $65 strike price that I already sold. Thanks for the thumbs up. I appreciate it. I'd have to pay the difference between the $65 strike price that I sold and whatever the current price of the stock is. We're up here at 66.97, and you can see that the asking price here is about $2.80. Almost all of that is basically just a reflection of the positive difference between 65 and the stock's current price nearing 70. Buying that back, if I wanted to try to ride that, means that on the covered call trade, I'd have to eat a loss of about $1.50, roughly. But if I saw upside maybe into the low 70s or the mid 70s, possibly, maybe there's a reason for that. If you're willing to hold that for the longer term. My speaking for myself, as Barry was saying, I'm okay getting called out and getting the money back. That's all right with me. I don't necessarily feel the need to ride these upward trends, although they are fun when they happen and when you are on them. I'm not going to certainly not going to argue that. That's a fun ride to take. But in the interest of what I do for Rebel Income, I'm really just about what is the income that is available to me right now? What is the opportunity that is available to me right now? And so I tacitly accept the limited upside that a covered call is going to put on how far my profit is going to go. Very 100% totally agree with what you are saying right now. I'm going to go ahead and give you some love on that comment. Be psychologically better for it to close out next week at 65.01. I do completely and totally agree with that. There's a little bit less of, oh man, look at that. Look at how far it's moved past my covered call price, right? A little bit less of that than there would be right now. But again, this is also just about accepting and understanding the trade that you placed and being okay with it. There is a mindset of successful investors, and I'm not just talking about put sellers or people who focus on income generation. Trading in general requires a certain mindset, and a lot of that is really about next trade up, next opportunity that is available, and that means win or lose. It doesn't matter what your trading system is. If you are focused on growth and you are trying to take advantage of short-term swings in the market using swing or momentum trading, whether you're taking a long-term approach by just buying a stock and letting it ride through an upward trend, or if your focus is on income generation, like what we do with Rebel Income, there is a mindset that you'd have to have in place that I think is the same through all of those systems. That is, that whether you make money, whether you lose it, whether you make money but not as much as you could have, you simply accept the reality of what your system is designed to do. And that means, in the case of CVS, being okay if it continues to push higher, being okay with selling it at 65 and not feeling bad about that, being content with that result and moving on. So thank you, Barry. All right, let's go back here to our track record. There are some put sales that are scheduled for the third week of March that I want to check in on really quickly. First one is on General Mills, selling the 57.50 strike price. Trying to expand and work a little bit more with some defensive stocks under current market conditions. It has seemed like a prudent thing to do, and I've had a few trades work out okay with that so far. So let's see where General Mills is. This is a trade that I've held for a little over a month, bringing in about 2.4% at a 57.50 strike. And wow, here's a big move today. That's unexpected. Even if it was down here in this range, 57.50, my strike price is down here. So this is looking pretty good for the next 2 weeks. Doesn't mean it couldn't drop back quickly down into this range and possibly into an area where I could get a sign. But so far, it looks like everything is favorable here. The size of this move, now this one does open up an interesting question. Let's go ahead and switch this here. And for reference, let's just keep in mind the premium I brought in, $1.40 is what I brought in on this one. If you're also in General Mills, this move brings up a very interesting question. Buying this back right now would require 40 cents, which would mean I could hang on to a full $1 of the premium that I brought in. That's not the worst idea in the world. In fact, I know of a few rollers right now that if they were sitting next to me, they'd be giving me a dustbuster on the back of the head saying, why haven't you already done this? 2 weeks to expiration, the stock significantly above the strike price that I sold. This is an opportunity to close out that position at a significant profit and to eliminate any potential risk of a drop back down to 57.50 in the meantime. I'm also not afraid of that drop, which is why I'm not going to do it. But if you wanted to think about rolling up to 65, which is the stock is 79 cents away from that with a lot of momentum going on right now, or even going to 62.50. Here's a 35 that $1.35 that's available at 62.50. So you're getting a little over 2% for 41 days. Again, this is a little over a month because this is a stock that does not offer weekly options. But if you wanted to think about rolling with the same stock, there's a couple of different ways you could do it that aren't terrible. If you didn't like the fact that this doesn't offer weekly options, then there's certainly a lot of other stocks out there that you could work with. Dale, great question. Let's wrap up on this one. If you get a chance, any thoughts on selling puts on Suncor? Thank you. Let's go ahead and take a look at that stock right now. And we do see that it's also dropping quite a bit. It's kind of like CTRA right now, which is another stock I've been paying some attention to for quite a while. It's picking up some bearish momentum as well. Give me half a minute. It's been a little bit since I did my last analysis on Suncor. There we go. $47. Stock is around $35.70. So big value proposition to be had right now on Suncor. Dividend is also looking even more interesting right now. So this is one thing to be a little bit wary of. I'm not saying this is a deal breaker, Dale. Last 12 months, net income was 11.8% and fell to 6.5%. So it's almost 50% lower in the last quarter versus the last year. That's something that points to inflationary pressures that are working against margins. With that said, free cash flow is growing, and that's kind of a counter to what's happening with net income. So it could be interesting. This looks like a pretty emotional reaction to exactly what, I'm not entirely sure. So this could be interesting. I would really need to probably dig into it in a little bit more detail. But it is interesting. Looking at the options really quickly. Let's go out a couple of weeks. Stock is at 35.74. That's interesting. 2 weeks for the $35 strike. $0.52 for 35.50 for 7 days. I'm not saying I'm going to place these trades. I'm saying they're worth thinking about. Who knows? Who knows, Dell? You may have just set the table for Tuesday's trade alert. I don't know. I'm not gonna make any guarantees, but possible. Very, very possible. Suncor is another one of these stocks in the energy sector that I like. They're right there with Coterra and some of the others that there is one concern that I have, and I think this is probably what, now that I'm thinking aloud about it, is probably what contributed to this. Suncor gives you a little bit more exposure to Canadian oil. With tariffs on Canada right now, that means that there may be a little bit more risk here. Maybe. Looks like they did moderate their dividend a little bit by about a penny, but that's not a terrible thing. So, Dale, it's interesting. That's going to be my answer for now. I hope that helps. It seems to rally from strong sell-offs. In many cases, that does seem to be true. And this is deeply, deeply discounted. It's got a very nice value proposition. Most of the fundamentals look really, really solid. So I'm not going to lie, I'm tempted. I'm going to need to pay some attention to it for the next couple of days before I make a decision. So Barry's still in MGA and KHC, about to be in Howe as far as our trades. Yeah. So, and I'm still on Borg Warner. I'm also still in KHC as well. So I'm right there with you. This rally is nice. So we'll see if it continues to push higher. So now, Dell, thank you. It's a great question, everybody. This is the kind of thing that I love about the live stream, and I love about our group is the opportunity to not just answer your questions, but to consider some of these different things and get some of these different thoughts and perspectives from all of you. Sometimes your ideas feed into the trades that we place. You can see that Maybe Suncor might be on deck next week. I don't know. Maybe it won't. I'm not entirely sure yet. Really need to see a lot of other things happen and make a good decision. Um, but this is something, and your thoughts about the way that you approach some of the trades that we play, some of the variations on a theme that we see, help to inform uh, hopefully the decisions that everybody else is making. Compare what information you're getting from me versus the way that you decide to deploy it. So DVN as well. Barry says, in fact, I have an open put for 35 to add into the 39 we were already in. Looks like I may be assigned. So DVN picking up some momentum. Sounds like on the downside. A little bit of a rally the last few days, though. Maybe it's starting. This one, DVN, this is starting to look like a pretty nice consolidation range between what, 33 and 38. That could be useful. So, all right, 39 actually. This looks like the top end of that range. So, all right, everybody. Thank you so much for your time. I know that we've gone a little bit over time, but I appreciate you being here and sticking with it. And I hope you found this to be useful. I know I always do, and so I really can't thank you enough for being a part of the group and for joining the live stream. If you have questions between now and next week, as always, reach out. Send me a message, rebelincomesystem@gmail.com. Reach out on the Discord server. If you're on Substack, then you can also message me there. Send me a message directly, or post a comment in the chat area on Substack. Let me show you that really quickly, and then we will wrap up. Right here under the chat, if you send a message there, I will see it and be happy to respond there as well. All right, everybody, thank you again. I hope that you have a wonderful weekend. Enjoy the week ahead, and we will talk again next time. Jay, in your case, don't worry about Substack. Just to go ahead and use either the open discussion area on Discord or message me directly on Discord. Yep. All right, everybody. Thank you again. Have a great week. We will talk next Friday.